All right, looks like everyone looks like they're in here, so we'll get this started. So good afternoon, everyone. You're having a great day, and welcome to our next quarterly market and economic update. My name is David Levy, of course, and I'm one of the partners and certified financial planners here at Diversified. As we've begun doing this every quarter, this webinar is designed to give our clients a recap of the last 3 months in the market and our outlook moving forward. The expectation is that we'll run 15-20 minutes of prepared remarks, and then we'll turn it over to any question and answer for the final 10 minutes or so. If you have any questions today, please type them into the Q&A box, and we'll try to get them answered if they aren't already addressed in the prepared remarks. With that said, I'm going to turn it over to Mike Horwath, our Chief Investment Officer, and here at Diversified, who will walk you through what's going on in the economy and the financial markets. So thanks for joining, and Mike, take it away.
Awesome. Thank you, David. So welcome, everybody. Once again, my name is Mike Horwath. I am the Chief Investment Officer here at Diversified. I appreciate everybody tuning in. Just a little housekeeping, just so everybody knows, with these quarterly updates, what we've tried to do now is put out, content via the webinar. I know sometimes it's easier just to listen in for 30 minutes over lunch, but you can also expect that there's going to be a longer newsletter that's going to get put out over the coming days. That's a little bit of a formal document that just recaps a lot of similar things. It goes into a little bit more detail because it's a written format, but just so you guys know, keep an eye out if you're interested in reading a lengthier, more detailed format for what happened in the quarter and just some thoughts about markets and the economy and things like that. Let's just jump right on into our quarterly update. So the first half of this year, let's just kind of sum it up like that, has been quite a ride, right? Things have been busy from an economic perspective across many different facets. You're going to hear a lot of buzzwords today, and we'll try to go into some of these things in a little bit more detail. But it's really been around geopolitics, the Fed, and inflation, right? And they're all intertwined. I think a lot of people want to talk about them in a silo, but a lot of these things are so intertwined into one drives another, and we'll talk a little bit through that. But I think that's important to keep in mind. But the first half of the year, it's been volatile. It hasn't just been one asset class. It's been most asset classes. And it's been dominated once again by geopolitics, the Federal Reserve, and inflation. So what's happening? So the Fed is changing gears. So for pretty much a decade, you call it 12-ish years after the great financial crisis, the Fed took interest rates down to the floor. And along the path from, call it 2010 through 2020, the Fed had tried along the way to raise rates, and they were successful kind of raising them slowly along the way just to normalize things. But by and large, it has been a very, very low interest rate environment. They have been willing to do that because inflation has been so low. There hasn't been an issue with inflation. And they've been fighting a couple different things along the way, right? One time it was slowing economic growth and trade tensions with China. At one point, we had the start of the pandemic. At that point, they took what little they had raised rates and they dropped them back down to the floor. So what's changed today is that inflation is now relevant, right? So with inflation running as high as it's been, the Fed has committed itself. They're essentially saying, we know we have to sacrifice economic growth for the sake of bringing down inflation. Their mandate, for those of you who have seen I think I did one earlier this year, a video on the Fed and what their role is. Their mandate is what they call a dual mandate. It's to keep inflation around 2%, low positive inflation, and to keep unemployment really at full employment, which they would consider, call it 4% or less. Well, what we see now is a strong economy, and we see unemployment at 3.5 to 3.6%, very strong labor market. But we see inflation running very, very high. So their job, raise rates, cool inflation. What we saw in the month of June at the last meeting has been one of the highest interest rate hikes in, call it, about 30-ish years. Since the mid 90s, we saw 0.75% interest rate hike. For perspective, coming into the year, before we saw what happened with Ukraine, before we saw how persistent inflation would be, the expectation was for, call it, 3 to 4 interest rate hikes throughout 2022 for about 0.25% on each time. So call it 0.75 to 1% of interest rate increases throughout 2022. Well, we just got a 0.75% increase in a single month. The minutes from their last meeting were released yesterday, and they pretty much showed that the Fed is fully prepared at the end of this month to do another 0.5 to 0.75% increase. A lot of it's going to depend on where inflation goes. We're going to know on next Wednesday. So the 13th is the next report for CPI, the Consumer Price Index. That's going to drive ultimately what they decide to do, at least a big part of what they're going to decide. What's happened, it's been multifaceted. This isn't one issue driving inflation. This is a war in Ukraine has caused a global energy issue. There had already been a global energy supply issue. This has only exacerbated that issue. So there's an energy supply issue. Commodity prices have increased. On top of that, supply chains from COVID are still all messed up, right? China, not too long ago, was shutting down cities like Shanghai. That's a problem for global supply chains, right? And then you also have really strong consumer demand here in the US that was driving, heavy demand driving prices higher. So you have this confluence of events, right? You have the demand side and the supply side all coming together. All of that's driving inflation kind of being this persistently high figure. But energy remains high. It's also been the best performing sector by far within the US this year. It's really the only one that's been positive. And really what we're seeing now is this R word, right? The recession word is being thrown out a lot. What we would say to that in short is, yeah, the odds have absolutely increased that we will see a recession here in the US over the next, call it, 12 months. What I would also say is that the market has already pretty much priced that in. The market has already priced in that the Fed is going to be very aggressive. So if you look on the right-hand side of this chart, we see that from the beginning of the year through the end of June, you see the entire yield curve, right? The entire bond yield curve has increased. So we saw bonds pull back all year. This is why, right? Bonds have sold off and the markets have began to price in that interest rates are going up. They have priced in an aggressive Fed, and they've also priced in that the likelihood of a recession over the next 12 months is likely somewhere in that 80-ish% range right now. Markets are pricing that in. So that's built into the prices, and we always have to remember that when we're talking about from today forward, what are markets already assuming in their prices. These are the asset classes. I've highlighted the major ones that we want to focus on: global stock markets and global or US bond markets. So you can see this year, global stock markets are down about 20%. Global or US bond markets are down 10%, right? This has been the story of this year. This isn't a stock market issue. This isn't a bond market issue. This is a global financial asset issue. All of this has been driven by, right, the volatility behind rising interest rates, right? Without getting into full-on details, the reality is that as interest rates rise, they are bad for asset prices. They just are, right? Because asset prices are driven by future cash flows, and those cash flows are brought to today to identify the price. It's worse for some assets than others, but higher interest rates are worse across the board for all financial assets. So this has been the story. There hasn't been anywhere to really hide. And a question we get a lot is tied back to, what's happened within both not only the stock market, but the bond market, because it's been quite a shock across the board. I already spoke about inflation. I think this has really been the moral of the story this year. This is the last 10 years of inflation. You can see, even despite easy monetary policy here in the US, where interest rates have been extremely low, inflation really was sticking around that 1.5% to 2% range. What we're seeing here is the green being what we would call headline inflation. That includes food and energy. The gray line is core inflation, which is inflation, but it strips out energy and food prices because those tend to be very cyclical, and they remove those to kind of remove some of the volatility that can come with those. But you can see across the board, both of these are rather high, right? And this is the ultimate problem. The Fed's main objective right now is to get those numbers to crest and start to come down throughout the rest of the year. And that will drive this next chart, which is where the Fed will take interest rates. So this is the Fed funds rate over the last really 20-ish years. And you can see, it's ebbed and flowed over the last 2 decades, right? Before the great financial crisis in 2008, they had been raising rates. We had the great financial crisis to stimulate the economy. They dropped interest rates to the floor. We had this slow pickup again in interest rates after, call it 6-7 years into 2016. And then here comes along the pandemic and they dropped interest rates down back to the floor. What you're seeing though is the combination of the blue, the green, and really the purple is the market implied and the Fed expected path for interest rates. This is what the market expects. This is what the Fed expects. And this is virtually what's priced into markets, right? That green line is what is priced into markets already. So what you can see is that the market is pricing in and expects that the Fed's going to raise rates continuously throughout the rest of this year, maybe early 2023. But they'll likely go beyond where they'll need to go, and they'll bring rates back down a little bit over the long term. But this is what has happened over the last 6 months. This is the rapid change of what's happened. You can see the steepness of that path because the Fed is chasing this. The Fed is behind the 8 ball at the end of the day, and they're trying to chase how we can correct the inflationary issue. So I know I just went through a bunch, right? And it feels gloomy, right? It feels doomy, gloomy, high inflation, rising rates, asset prices fell 10 to 20%. So what do we do, right? And I'm going to try to put on my happy hat now, and let's talk about the silver lining behind everything, right? The perspective that we need to keep when all of this noise is going on. Because things are noisy, things feel volatile, things feel anxious. So what's the silver lining behind it, right? So why would we be optimistic? First off, we need to keep a long-term perspective. We'll talk about this in a second. Market valuations, when markets have fallen the way that they have, are much more attractive and reasonably priced than they've been for quite a while at this point. There's still a lot of excess savings in the market. So you're going to hear the R word thrown around a lot. We can talk about that a little bit, and we have talked about that. We will. But there's a lot of excess savings built up, and the consumer is what's going to continue to hold up this economy, right? So even if there is a recession, our belief and our expectation is it will be a shallow and short one because of how much consumer spending will continue to reign pretty high at this point. And then lastly, I think you have to think about the consumer confidence level. Consumer confidence, and I'll show you a chart on this in a second, is as low as it's ever been, right? People feel anxious about inflation, about the path of interest rates, about what's happening globally. There's geopolitical issues. Historically, when consumer sentiment feels the worst, it's often a good time to get invested, right? And we'll talk about that. But looking on the right-hand side, I think first and foremost, we have to start with keeping a long-term perspective of equity markets. This is the S&P 500 since the early 90s, right? If you look at this chart, the path is up. If you break this chart into little chunks, the reality is it's like a roller coaster. It happens. We know when we invest into stock markets, they are volatile. They work over the long term. We fully believe that. What we have to be able to do is take a step back and know that we are not investing in equity markets for 1 year, 2 years, 3 years. We would never advise somebody for short-term needs to invest into the equity markets because of the volatility of this. But what we know is the equity portion of our portfolio is going to drive growth over the long term, and it's done a very good job keeping up and outpacing inflation over the long term. So it provides real growth above inflation for our portfolios. It needs to be kept in perspective that no matter what happens in February and March of 2020, whatever happens in the first 6 months of 2022, yes, it's bumpy, it doesn't feel good, but the reality is this part of our portfolio is a long-term asset, and that's the way we manage these portfolios and the only way that they're going to work. The other part I would point out is this is the stock market valuation, what we call the forward price to earnings ratio. So it's really how cheap is the market? Is it very expensive? Is it cheap? What we've seen is if you're an equity investor today, you look at it and say, we sit at almost 16 times earnings, right? So prices have come down such that it's a much more attractive place to buy. It's actually below its 25-year average. So if you're an equity investor and you look at, are things still expensive? Or if I'm looking to deploy cash into the equity markets today, we're not saying let's time the market. We're not saying any of that. We're saying this is a good objective way to look at the markets and what the pricing looks like. It is much more attractive to invest today than it was 6 months ago. It was expensive 6 months ago. Also, 6 months ago, when interest rates were at the place that they were at the really the bottom range of where they've been historically, it warranted paying a higher price for them. That was okay. But now that interest rates have risen, we have to reevaluate that part of our portfolio, and they've come down, but they've come down to still a pretty attractive level. Keeping a perspective on value in the markets is a good way to look at what you're investing in and what the price is you're paying for that. This is consumer excess savings. So I spoke about the consumer, right? Consumer spending is 70% of US GDP. Inflation is going to affect consumers. The unfortunate part is inflation is going to disproportionately affect the lower income individuals. While lower income individuals have a higher propensity to spend $1, right? If I gave somebody who makes in the lower income bracket $1, they're likely to spend it. If I give someone who makes a ton of money $1, they're likely to just put it into the market. Right. So while, yes, it's nice, especially when lower income individuals get some sort of stimulus because they're going to spend it, they're truly going to stimulate the economy. And inflation, unfortunately, disproportionately affects them. If you look at the top 80% of asset holders or income earners, they still have a ton of excess savings, $2.5 trillion. For perspective, the US economy is $25 trillion. So 10% of the US economy is sitting in excess savings that can still be deployed into spending. You're seeing demand, while it may come down from the very, very high levels that we saw in 2021. Since 2020, excess savings have been so high. And this is what's going to keep the market afloat. This is what's going to keep the economy afloat. Even if we see a recession slightly pull back, this is a great starting place for markets when the Fed is raising rates, because they're trying to slow the economy, but the consumer remains strong. This is consumer sentiment, right? So I had mentioned consumer sentiment, how it ebbs and flows. This is all the way back to 1970. So you see over time, consumer sentiment ebbs and flows with market conditions, right? Sometimes people feel really good about markets. Sometimes they don't feel as good. What we've seen, if you look over to the right, more recent times, is as low as we've ever seen in consumer sentiment. So consumer confidence, it's a survey typically done by the University of Michigan. They ask individuals how they feel about making purchases, how they feel about inflation, how they feel about various topics, economic related. It's as bad as it's ever been. When you do the research to look at historically when this peaks and when this troughs, investing from that point forward has historically shown that when you invest at a trough, clearly markets have likely pulled back. Things feel bad. Most people don't want to be investing. They want to pull out of markets. The return over the next 12 months tends to be substantially higher than investing when things feel good, right? And it kind of makes sense. Warren Buffett always said, I always love quoting him, right? Be fearful when others are greedy and be greedy when others are fearful, right? When things feel bad, when things pull back, likely investor behavior has taken hold. They typically go past where they should go, and it's often a good time to invest. We're not advocating timing markets. We're not advocating changing your risk tolerance. But what we're saying is when you look at today moving forward, today may not feel good. But these are often the times when you look forward and you say, it's probably a good time to invest money. And it's probably going to be much more rosy, looking 12 months out. So in summary, where do we go from here? Things are going to be foggy, right? Everything is going to be driven by inflation. Inflation is going to drive what the Fed does, and what the Fed does is likely to going to determine how much demand they're going to squeeze, where mortgage rates goes, go where debt costs go, right? So if as interest rates go up, debt becomes more expensive, people spend less. That's what the Fed's trying to do, slow the economy a little bit to try to bring down inflation. But it's going to be foggy until we get clarity around what inflation is doing. We expect inflation will come down by the end of the year. The question is how much, right? The slower it reacts to the Fed and what they're doing, the more aggressive they're going to continue to be. The quicker it comes down, we may see that the market implied too much interest rate increases. We'll see where that goes. The bond markets, it hasn't felt good from a return perspective in the last 6 months. But if you're a bond investor today, your portfolio now yields much more. It is a much cheaper looking portfolio. And you're going to get, like I said, much more yield, and the return prospects of your bond portfolio look much better today than they did 6 months ago. It is actually a pretty good time relative to 6 months ago to invest in the bond markets, even though we felt that pain for the last 6 months. And we continue to see corporate earnings. We expect corporate earnings to probably come down a little bit. I think it's natural given what we're seeing management of these businesses talk about. But earnings are coming off of a very strong year. They're still expected to grow mid-single digits on the year. Once again, this will likely be driven by the path of the Fed, which will be driven by the path of inflation. Lots to see here and shake out the rest of the year. How are we positioning portfolios in this environment? We said it last time, we're holding true to it. We're overweight the US over international. We look at Europe and we think that their recession odds are higher than the US. And we think that it's a harder environment for them to come out of than it is for the US. We are overweight US over international. Within the international space, we do lean towards emerging markets. We still see them as a long-term growth opportunity, and they add more diversification than areas like Europe or Japan would add, at least in our opinion. We're leaning towards higher quality businesses, meaning we're not looking at these high growth, non-profitable businesses. We're also not looking at these really beaten down businesses. What we're looking at are businesses that are high quality, which means low debt, a lot of business lines, a lot of channels, a lot of diversity among the revenue, just high quality businesses, more stability in this type of environment. We do have some tactical views that we've instituted. Some haven't changed, right? We're still looking at semiconductors and infrastructure, which is mostly industrials and material type companies. Biotechnology still looks really cheap. We like that area. And we've added to energy, right? We've reduced our financials exposure and added to energy. Energy, despite how well it's performed this year, it is still the cheapest relative sector of the market relative to its long-term price to earnings ratio. So we like energy. Higher energy prices are going to be good for the bottom line ultimately of those businesses, and we're going to lean a little bit into that area. Within our bond portfolios, we made a couple of tweaks, one of which is to add to duration, which means we added some interest rate sensitivity. We did that because we believe that interest rates are at the high end of where they're going to go. And by doing that, we were protecting our diversification a little bit more, right? Higher duration, adding to a little bit of government fixed income will help us if markets pull back a little bit further. Not that we expect that, but it just adds to diversification, which is the point of why we have fixed income, to add a little bit of stability. We believe rates are at the higher end of where they're going to go, at least in the short term. We also added to tips, right? We've had tips in our portfolio, so Treasury inflation protected securities. We're just adding a small piece there, and we're keeping a piece there as a hedge against unexpected inflation. The market has priced in what they expect inflation to be. What we're looking at is, what if inflation remains persistently high? We want to have that piece because it'll help offset any of those risks in that part of the portfolio. So really just summarizing everything, inflation is going to be the key. I've mentioned it multiple times. Inflation is going to be the key for the Fed, and ultimately, the path of where interest rates go, which will be a big part of where financial prices go in the short term. The markets are pricing in that the Fed is going to be aggressive. If the Fed happens to be less aggressive and is able to get inflation down quicker, it'll be a nice tailwind to markets. But that's really a wait and see approach to where inflation goes. Energy continues to remain high. It has come down a little bit based upon expectations that demand's going to come down a little bit with higher interest rates, but prices still remain high, should be a tailwind for energy businesses. But you're going to start to hear concerns over consumer spending, concerns over corporate earnings. That's just natural with comes in with as to what comes in with recessions. What we would remind people is a lot of this is already priced in the markets, and markets are pricing in a much more attractive value for equity markets. It's not that they're extremely cheap, but they are much cheaper than they were a mere 6 months ago. Investors should continue to expect volatility in markets because a lot of this is data dependent. So when inflation reports come out, when the Fed makes their decisions, you're going to see volatility. You have to remember to stay out of the minutia, stay out of the noise, keep a long-term perspective, and focus on what we're doing in our portfolio and for how long we're trying to do it. Said a lot, Dave. I'll kind of turn it back to you and see if there's any questions that have come through.
There was a couple that came through here. Says I believe you stated the recession will be shallow and short. Please define what shallow and short means.
Yeah. So what I would say is the recession that we saw with the pandemic was deep and short, right? So a recession is driven by several factors. A lot of people like to just say 2 consecutive quarters of negative GDP growth. So 2 consecutive quarters of negative GDP is a recession. It's not technically true. Technically, there's a group of people who make that determination based upon unemployment and stuff like that. But what we mean by shallow and short is we don't expect GDP to fall the levels that we saw in the great financial crisis or what we saw based on the pandemic for that period of time. What we'd expect is maybe 2 quarters of negative GDP, slightly negative. The Fed gets through what they need to get through for inflation. They probably start to drop interest rates again, and then consumer spending will pick right back up. So we expect it to not last, 4 quarters in a row. We would expect it to probably be 2 quarters, and for those 2 quarters to be not overly negative, just slightly negative, which still technically could become a recession. We'll see what the experts ultimately call it. But that's what we mean by it. Not long-lived and not super negative from a GDP perspective.
Okay, helpful. Do you expect a housing crash to follow this?
No, I expect housing prices to come down. What we saw in 2007, 2008 was a systemic financial problem. We saw leverage through the roof. We saw people with 3 houses with adjustable rate mortgages who were way overextended, buying at extensive prices. And we saw derivative contracts written by companies to hedge the risk of default. And when everything collapsed, it was just systemic. That's not today. What we would expect, though, is that higher mortgage rates are likely to pass through to make demand drop a little bit. With lower demand, we're going to see that sellers are not going to have the power that they've had over the last couple of years, where they could just demand 20% over asking or 10% over asking with no inspections or things like that. That'll likely start to phase away. So we would expect housing prices to come down, but the debt levels that people are carrying are not out there. If you actually look, they're probably lower than they've been over the last decade. The debt to household disposable income, they're lower. The consumer is very strong. What we'd expect, though, is that the market becomes more normal, right? When I bought my house several years ago, you kind of just assume that you'd buy the house at 5% under asking. You go through the inspections, you ask for a couple of things. That was normal. Today, we literally have to waive everything and buy in at 10% over, and it's absurd. So that's going to normalize. But that normalizing doesn't mean that housing prices are going to collapse. We don't see the same type of financial stress or financial strain that will happen now.
Good perspective. I know we're running short on time here. We'll try to squeeze 1 or 2 more in. So why have bonds fallen this year? And is it time to remove them from the portfolio?
Yeah. So it is not time to remove them from the portfolio. It has been a unique year, and most people are used to when equity markets fall and when volatility picks up, where do investors flock? They flock to high quality bonds, right? Bonds, they're safer than stocks. The challenge is that bonds face a couple of different risks, two of which are interest rate risk and inflation risk. So bonds are typically debt issued by the government. They're a combination of mortgages or debt issued by companies, and they often have a fixed rate. If you think about it, as interest rates rise, that means new debt's being issued with higher rates, and the bond that you own is just worth less. So that it has this inverse relationship. On top of that, we've seen inflation remaining persistent. The first 6 months of this year, where we saw equity markets pull back and bond markets pull back, was a very unique circumstance. I expect that to revert back to its normal diversification moving forward. It is still an important piece of our portfolio. Markets have fully repriced in a lot of this stuff. And now we're starting to see demand pick up for government bonds. We're starting to see government bonds offer that same diversification benefit that they normally add. It is still an important part of our portfolio. It will still be a stable part of our portfolio. If you look at the first 6 months of this year, it didn't feel like that because of the kind of the circumstances of the Fed trying to chase this thing, which is really the primary culprit. But moving forward, your expected returns from your bond portfolio have now increased. The yield in your portfolio has increased. And I think that diversification is right back to where it was.
Okay, we'll squeeze one more in here. And for those that your question was not answered directly, we'll make sure that someone from our team gets with you and answers your direct questions. So sorry, we aren't able to get to them all today. Love seeing the questions though. But I think this is a good one to sort of finish it on. And you did touch on it a little bit, Mike, but I know it's on everyone's mind, which is sort of what is the light at the end of the tunnel, right, for this pullback, and you know what needs to happen to turn this around, right? What are we looking at? I know you touched on it a little bit, but this I think is on everyone's mind.
Yeah, I think it's a good place to end. And this is something we talk about internally a lot is what is that light at the end of the tunnel, right? Because right now, I think a lot of people sit back and they ask themselves, well, what needs to happen for this thing to even just to remain less volatile, right? Just even hold true. At the end of the day, it's one word, it's inflation. Inflation at the end of the day has to come down because the Fed is not going to really stop what they're doing, which is the primary culprit of why assets have repriced the way that they have until inflation starts to come down. They have two mandates: low unemployment, getting inflation down to 2%. I would be shocked if inflation's down to 2% at the end of the year. It doesn't have to be down that way. What the Fed's going to want to see is that over the next 2 or 3 monthly inflation prints that they get, the CPI, the Consumer Price Index, and the Personal Consumption Expenditures Index. Those are the two main inflation indexes that they look at. Those two have to show that they've peaked, that they're coming down, and then the market will slowly become more optimistic moving forward. And then you can start to see the light at the end of the tunnel that the Fed is going to stop raising rates, that they maybe will be open to reducing rates if economic conditions start to slow so much, that they will be willing to maybe drop interest rates a little bit. We're not there yet. We're, I think, several months away from really knowing what that answer is. But the light at the end of the tunnel is that demand's going to slow and that we have to see inflation slowly come down. The quicker it comes down, the better. It's hard to imagine that it goes from an 8.6% annualized down to 4% in a month or two. It's likely going to take several months, but what you want to see is this maturation that it slowly comes down. And as inflation comes down, you'll start to hear that light at the end of the tunnel from news outlets, from economists, and that's really what's going to be the driving force behind it.
Okay, good. Well, thank you everyone for joining us today. As always, we'll have this saved on our social website. Share with anyone you think would find value in this discussion. We're here to help. Reach out if you have any more questions, and I guess enjoy the rest of your summer. We'll see you same place, same time 3 months from now, give or take. So thank you everyone. Have a great day. Talk to you soon.